following show is intended for mature audiences. Viewer discretion is advised. We are live. Coffee with the Johns. Friday, June 25th. Last Friday in June.
I mean, it's next weekend, baby. 4th of July. Woo!
Oh, that's right. Your favorite holiday.
Second favorite.
Your second favorite.
Yeah.
What's the first one?
My birthday. The holiday.
Oh, that's right. You don't work that whole month. I forgot. 4th of July, you do go crazy. You have your... Just don't wear that 4th of July thong again when you go to the pool because it just it creeped out a lot of people,
That's what I'm wearing next week.
It creeped out a lot of people.
I'm like freezing, though, on that in here.
You're going to what?
Freeze in here wearing that.
You're going to freeze wearing that?
In here for the show?
Oh, tomorrow? In the office. I thought you meant in Texas. I was like, come on, man.
No.
Oh, yeah. Yeah, we're going to be probably dressing up. I forgot all about that. I'm going to find something crazy 4th of July-ish.
Yeah, I don't know. You better get on it because Amazon's been slipping lately as far as product availability and delivering and stuff like that. I was trying to order something that I've ordered for years and like out of stock. I was like, what? Amazon's out of stock? Like, what the shit? Like, you only had like a small of some compression shorts, and I was trying to find some pre-work or protein powder or something like that.
Yeah.
And like, nope, out of everything. I was like,
well,
damn.
Supply chains have been getting affected.
I got some articles in there. Like, if you have a commercial driver's license right now, you can make bank.
Oh, we're going to be talking about that because that's also been affecting the airline industry. So we have a lot to cover. We're going to be actually covering the next housing boom that's expected. I know a lot of you are saying, aren't we already in a housing boom?
Nope.
Well, seems like it could get boomier. It seems like it get crazier. And then
that's a new Johnism.
Johnism. Yeah, it's a boomier economy. We're going to be talking about the crypto scams and the crash that's been going on in the crypto space.
Oh, has it been crashing?
Yeah, it's below 30 grand last I checked.
Oh,
so
I haven't checked in a while.
Who could have seen that coming? We have a lot of topics about the market, a lot of interesting stuff. Also coming up, August, probably like the second weekend in August, or second or third weekend, haven't decided yet. We're going to do a workshop that's going to be live and in person here in San Antonio on how to actually manage a rehab. So we're going to be going over everything we do when we manage rehabs, contractors, scopes of work, materials, everything. Yes, it will be a paid event because it's going to be for more of those of you that are actually doing rehabs, not for those of you that are perpetual learners. It's a very in-depth workshop. So if you want to find out more about it and get some great discounts for that workshop, you want to text the word workshop to 210-794-9898. And as soon as we go live, you will our text community is actually going to get a really nice discount for it. So with that being said, let's get into the show.
Oh, little side note. I was first this morning.
Side note to what?
I was the first this morning. Hit the like button. I was number one. I'm number one.
So, I'm your host, John Barbera.
As a person to remind everybody, hey, hit that like button a little bit.
Dre, can you just mute his mic for the remainder of the episode and shut off the camera?
Yeah,
we're just gonna block John out until the coffee kicks in. With me, as always, is co-host John Barr.
The better host.
Right, yeah. So
jokes for days.
This has been a good week. We closed another property that we sold. That one went through, no problems. Crazy market, crazy offers.
Oh my God. It was one of those that just like we just happened to luck in and buy at the right time and obviously sell it at a substantially higher than what we originally thought for. Because I mean, I was looking at it, it's like what we anticipated the value was. And then what it actually turned out to be when we sold it, just like, good Lord. And it's like, and I almost look back, I'm like, man, I feel bad. It's like a little bit, but it's also looking at like, well, no, when we ran the analysis, when we bought the house, like the comps did justify the price at that time. That's also what we buy for what it's worth as if we sold it that same day. The fact that the market appreciated so much in that short period of time, it's like, well, that is the payoff for taking the risk. Because it's also like, it could not go up too. all of a sudden it could turn around and go backwards. Like that is what happens when you buy actual assets. It's like you're buying with what you think is going to happen or what it's worth today or what it's going to be worth when you go to sell it, but the fluctuation can change.
Yeah.
So I know it became a huge problem for I think it was Lifestyles. I heard it was a while back, but a guy had a long rehab for a duplex that he was doing. So when he bought it, he had anticipated a value of say 180 or something like that, and then 6 months rolled by and all the comps they used had disappeared, and then some things got put on the market that actually brought the value down to like 165. And so when the guy went to go refinance and do permanent financing, they valued it at 80% of 165, not 80% of 180. And he ran his numbers off that 180. Yeah. And then he had to put way more cash in the deal, and it just destroyed his returns as far as like cash on cash returns and stuff like that because the amount of money he had to leave in the deal. And then that happened to us last summer.
I was going to say
with the deal that like it wasn't as that well, it was pretty drastic. Where we had to end up keeping it when we wanted to originally sell it.
Yeah, because we had the comps, we had everything look great, and then all of a sudden by the time we put it on the market, that comp that we were using fell off, and the new comps dropped our value.
Yep. And so, like, son of a bitch.
Yeah. So, I mean, it actually ties good into this article that I have here of more than half the homes sold are being sold above asking price in May. So the median home sale price hit yet another record high in May, up to $377,000, a 26% increase year over year, and 54% of homes sold above their asking price in May. Another record high, up from 26% a year ago. So the report also shows the housing market also set new records for home selling speeds and competition, although seasonally adjusted home sales and new listings flattened from April. Leading indicators of the housing market activity are also declining into June, signaling that the pace of the market may be slowing. So this is something that I find always interesting when you do market updates and everything is like, yes, the year over year, but in the current market that we're in, that's so crazy because last year was a completely shut down year. It's also seeing what are the trends month over month. Are we speeding up or slowing down, especially as we're getting into those hot months? And it continues with May marked the likely peak of the blazing hot pandemic housing market as many buyers and sellers are vaccinated and returning to pre-pandemic spending patterns. Sellers are still squarely in the driver's seat, but buyers have hit a limit on their willingness to pay. The affordability boost from low mortgage rates has been offset by high home price growth. So roughly 1.3 million homes were listed for sale in May, and 1.3 were listed, and 615,000 homes were actually sold. So
only 2 months inventory.
Right. So very interesting. And then it talked about how median sales price also increased from a year earlier in all of the 85 largest metros that Redfin tracks, partly due to a shift in the mix of homes that are selling toward larger, higher-end properties. And the smallest increase was in San Francisco, where prices were up 2.8% from a year ago. The largest price increase, surprise, was Austin at 42%.
That was the second month in a row that they've had over 40% year-over-year appreciation, too.
40%.
Yeah.
It's insane.
The new market update that's going to be coming out next weekend?
Yes.
Yeah, next weekend.
I was actually thinking of releasing it Wednesday because of the 4th of July weekend and everything. People are probably going to be too drunk to read it. So, I don't know.
Okay. Yeah, but anyways, like I was running those numbers and I just saw that and I was like, dude, because I do a chart that it shows appreciation from like 2012 to now. And then you're seeing like 10%. Like Austin always looked hot. And then all of a sudden it looks like minuscule because you did this. It's like kind of the unemployment that spike where it just went from like 10%, all of a sudden is up like way up, or 7% in the last two recessions and it jumped to 14. It looks like, well, those ones are babies compared to this one. But now Austin is the exact same thing. It's like it was hitting 10, 12, 15%. I was like, that's just really high. And then all of a sudden now it's like, oh, that doesn't look that bad compared to now because this chart just I had like add an extra 20% to the chart.
That's
because
insane.
Austin's just gotten so insane. I mean, San Antonio hit a new record too. We hit the highest appreciation we hit, but nowhere near Austin.
Don't give it away.
I didn't say the
don't
number.
Don't give it away.
I didn't say 19.4.
So if you want to know that, then you must text the word market to 210-794-9898, and you will also get a copy of all the zip codes and everything that we put out that's a part of like the months of inventory.
The good stuff.
But also continuing, what I found interesting is that Austin is at 42% increase, but you have Phoenix at 33% and Detroit at 32%.
Well, yeah, when you start at $5,000, it doesn't take much to go from 5,000
But
to
there still
8,000.
needs to be demand, though. It's like, what's the job market? What's all that looking like in Detroit?
When you're moving out of a $5,000 house to an $8,000 house, the demand is just like, you have that one cash.
Yeah. But it's like, what's the job growth and everything like that in Detroit? Because I did an interview with this gentleman that he's out of Utah but invests in Detroit, and he does Burr and buys rentals and everything from a distance. And it was the same thing. It's like, I get Detroit's affordable. I get you're getting great deals and all that. But as far as the job market goes and policies and everything like that, I'm actually curious because Detroit, from everything I've heard, never been there, everything I've heard, it's a shitty place. Like, it's cold. It's, it's kind of ghetto in a lot of the area. So I don't know, never been.
I bet that was because a lot of places it was just kind of that old sleepy Rust Belt city that had kind of died off. It was great cash flow, but you weren't getting anything from appreciation from it.
What they had, like Motor
City?
Yeah, it was known as Motor.
GM
was there.
GM, Chrysler, you had all your big auto manufacturers there,
Right.
and like the post-war boom, and like it was at one point I listened to an interview with Bet David about it, and he said it was at one point was the Paris of the Midwest.
Wow.
Like Paris of the world, of our side of the world, just because the income levels, the amount of money, everything was there. And it's like, but then the politicians got involved about how everybody was, yeah, I'm from the government, I'm here to help kind of thing. And they came in there and started outsourcing everything and trying to get labor unions. And then like everything just that city got decimated. But I bet that was, it's going back to like real estate. Like, I bet that was a huge, nice little boom to people who were like, the value's up 32%. It's like, son of a bitch. Like, I was really just like using this as my cash flow play. I just retired on that money and didn't think values were going to go anywhere. And now like up 32%, like people are buying. Might be a good time to sell there.
Might be. But continuing with this, some more stats that I found interesting from Austin is that it's still the nation's hottest housing market as tech workers continue to flock to the Lone Star State's capital. In 2021, 1,400 Austin homes have been sold between $100,000 and $300,000 above asking price.
Oh, I was like, man, 100,000.
Yeah.
Like, man, I was like, that's a big range. But
and 72 homes have already sold for $300,000 or more above asking price. At the time of last year, only 2 homes had been sold in Austin for more than $300,000 above asking. So last year, only 2 homes, 300 or more above asking. Now 72. More than 4,500 homes in Austin have been sold between $25,000 and $90,000 and $100,000 above ask. Homes are staying on the market in Austin for an average of only 24 days.
Yeah, they had some just abysmal inventory markets there.
Just well, like, I mean, when you're seeing how much over ask they're selling, I mean, crap, that's insane. So my thing is like, when I was reading this article, is like, when is this, when is it going to slow down to a point where it's like,
never.
It's just getting to a point where less and less buyers can actually afford to pay that, 100, 200 grand over ask, because it won't appraise. So you got to come out cash. You got to waive contingencies. I mean, at what point is it like, are we ever going to tap out those people, or is there's just like an endless supply of people that just have fucking $500,000 of extra cash just burning a hole in their pocket?
Well, it's all tech money, and like, where did all that government stimulus money and all that pumping of assets go? It went to the stock market and went to tech companies. Like,
yeah.
I have that article about Microsoft and Apple. Like, what happened with them?
Yeah.
It's like that money went there, and who gets that money? It goes to the people that own those assets and work for those companies and are wealthy. It's like, that's where it goes.
So even on that topic, the next article that kind of like piggybacks on that is you have what we talked about at the beginning is Americans are on the cusp of another borrowing binge. So pretty much what led to the 2008, the biggest housing bubble and everything, was too much credit, too much borrowing. People were over leveraged tremendously, which put them in a very bad position. And they're saying we're about to see another one of those start forming now because investors are concerned that the U.S. is headed for a repeat of the lackluster economic expansion of the prior decade, that once the country gets past reopening pains, it will resume the same modest but steady growth that was interrupted by the pandemic. The plunge in 30-year Treasury yields last week after the hawkish turn from the Federal Reserve only heightened the sentiment. And they say that because the view overlooks a key factor that held back the economy in the 2010s and that should now boost it through the 20s, household balance sheets. Americans are richer than ever before thanks to the booming stock market coupled with the surge in home values. And households aren't burdened with the same level of debt that dragged on spending in the years following 2008 recession. That should mean faster growth in the years to come as Americans again feel free to borrow. So between the end of 2019 and the first quarter of this year, household liabilities rose 5%. Only 5% household liabilities. But household assets rose 14.8%. So that's an insane amount, because usually, I mean, in this country, based on everything that we've read through economic books and people like that and articles, it's kind of the opposite. It's always been, the American household has more debt than assets. The average American household, especially the lower income. But now the liabilities have only risen 5%. That means that people are just not taking that kind of risk of borrowing. Yet the household assets have increased 14%. And that's the kind of balance sheet math that should put households in a spending mood once they've put pandemic fears behind them. So the rise in leverage that restrains economic growth in the 2010s began in early 1980s. As interest rates declined, households increased their debt faster than they grew their assets, and that trend continued for 25 years. Then as the home prices fell in the late 2000s, American assets, houses, and stock holdings lost value with their debt levels. So yeah, pretty much when the housing crash happened, the stock market crash happened, people lost all their assets, right? Their home.
Well, they got super skeptical of it, and like they sold all their assets out the baby boom generation.
Well,
a lot of them are just
a lot of them had to
sell it all off, and it's like I can't take this pain anymore. From
401ks took a hit, pension funds got wiped out. I mean, there's people's retirements got wiped out during that crash. So yeah, a lot of those were their assets got wiped out, and what was left is all their debt because that didn't get wiped away. So the net effect is that by the end of the first quarter of 2021. The ratio of household assets to liability is close to a 50-year high and continues strong gains in the home values and stock prices in the second quarter of 21. Even the bottom tiers of household, this was interesting too, even the bottom tiers of the household net worth distribution, wage growth is surging, and child tax credit payments included in the American Rescue Plan beginning on July. So there's a reasonable amount of inclusiveness here. We're already seeing homeowners beginning to take equity out of their houses again, though nowhere near the levels that we saw in the mid-200s.
200s? You mean mid-2000s?
2000s, yes. Whatever, an extra zero. At the peak of the bubble. The oldest members of the baby boom generation are now 75 and will find themselves drawing down their savings, selling their assets in the years ahead, and millennials looking to buy houses will find themselves taking on debt like generations before them. Low interest rates make debt management easier than ever before. So here's what I'm looking at is kind of like what we saw in 2008, right? Is people right now, what's making their assets go up is the stock market that's booming. Housing market that's booming. The stock market takes any kind of large correction, that boom will essentially get wiped away. Well, and in a situation where people are kind of wary and they're still kind of timid, they're not getting into a lot of debt. If something was to happen soon, my theory is that would just further extend that fear people have of jumping into debt, which is something that the government, the economy, everybody needs, is for people to get into more debt to keep the economy moving.
I think it's also, I think this is exactly what they've been trying to do. Because I remember specifically, like Ray Dalio, like he talked about, it's like the monetary policies of like how they used to run, and that's how. Then the next thing was like how they did it through pumping asset prices. Is like how they used to get out of recessions is they lowered interest rates. Well, then when they stopped losing that ability, it was like, okay, well now we need to do quantitative easing. Never been heard of, never thought of doing before, and that brought us out of last recession. This next one, it's not going to work the same way. Like you have to find out ways to get money to the bottom tiers of people. You have to find ways to get from the money to the bottom. Policy needs to figure out how to do that. And this is exactly what they used this pandemic for. And it worked, and it's working perfectly well. It's like these child tax credits, to where a lot of you have a gap where your wealthier people tend to have less kids, and your poor people have more kids that are like in poverty levels. They usually have 4, 5, 6 kids because the government's taking care of them. But now you get these child tax credits per child, and you're really going to pump a lot of money into the bottom part of the economy, into people's hands. Then those people don't have the assets. Yeah. To where it's like, yes, the stock market takes a correction, but your average day consumer doesn't have $400 in their checking account for an emergency. Now has cash, is getting cash, and they don't care about what the stock market's doing. They're going to go spend. And now when you have this misallocation of labor, and you have all of these entry-level positions that are open across the board that aren't being filled, it's forcing companies to pay more money. Yeah. So that's where now they're going to even have better, more sustainable jobs along with it. To where, yes, your high end might take a hit and your luxury purchases and stuff like that, but I think your entry-level, everyday products are going to be what sustains those things. And I mean, there's these valuations in stock markets that are just through the absolute roof, and there's corrections that can come from that because of the amount of liquidity, but that's going to hurt the people that have those assets. But they're trying to get money to people that don't have assets.
I disagree.
You always disagree.
Of course,
you're wrong.
There's facts, and then there's your opinion.
Yeah, your opinion. I just gave you the facts. Boom.
The way I look at it is that, like you say, yes, there's assets overvalued tremendously, right? We talked about Tesla, Bitcoin. We're seeing it. We're seeing it in a lot of just things that people found themselves with a shit ton of money. Robinhood app that lets any moron invest in stocks now. It doesn't matter if you know anything about it. So you have all of that, and you say, okay, if any of those assets that are over leveraged fall, is going to hurt the big people. It's like, I don't think so. I think it's going to hurt everybody, because the big people, what happens? A lot of them, the same thing that happened in 2008. A lot of people are working on margins. So those margin calls start coming in, and the way for you to take care of those losses is you got to sell assets that are actually performing, which is what tanked a lot of the economy in 2008, because they had to liquidate. Tanked. Okay, but it doesn't matter. Yeah, one thing leads to another.
But yeah, I know. But that also led to a lot of policies coming out that banks can't do that anymore. Like the article came out. I mean, it was just the headlines.
Yeah, but we're seeing with the hedge funds now too, that they got this fucking destroyed with GameStop, and they had to even shut down trading to protect them. You know what I mean? Because like they were over leveraged on GameStop.
But that's hedge funds. And it's like, but like
they control a lot of money.
Hedge funds, banks, everybody was over leveraged in 2008. Now they're like the policies got in place that your biggest financial institutions, the 23 biggest banks, can't do that. They have debt to income levels that they have to keep, and have to pass certain stress levels tests based on 2008 if that event were to come.
You think that even then they're still not going to sell higher performing assets to keep those levels secure, because they got a liability or whatever in their business that they can't just liquidate, all their savings to take care of that? Like they're going to have to liquidate assets as well that are performing. So I think the repercussions of like how everything, the domino effect plays on all this, I think will affect everybody, because the big people get hurt, they hurt the little people, right? Because everything starts at the top, big corporations, money gets tight, interest rates go up, this company gets hurt, this distribution gets set, and then it trickles down, and the
interest rates don't go up.
Well, that's going to be another curious thing, is like, how is the Fed going to handle the Fed and the government going to handle pretty much the inflation that we're seeing, everything that we're seeing, along with, if you want people to borrow, you got to keep interest rates low, so there's more incentive to borrow. So if you start raising interest rates now, you're going to de-incentivize, disincentive people from wanting to go borrow, right? So I'm curious to see, like, how's that balance between inflation and then trying to control the inflation by raising interest rates, and then also allowing people to get in and pretty much borrow with all these things. I think like it's a very interesting, intricate system that they've developed and that we're in, that I'm curious to see, you know, kind of, I always hear economists say, you know, what's going to be that straw that breaks the camel's back? And I'm trying to see, it's like, what would that straw look like? You know, if there is something that could really tip this whole system, in which area could that really come in at? Because everything has seemed so entwined that's like, I don't know. It's scary and exciting all at the same time.
I mean, it is, but I mean, one of the reasons that 2008 got so bad is because there was no liquidity vehicle to get liquidity into the market, people that needed money. But now that vehicle is there and it's been well established and well utilized to keep things from crashing like
money
that.
printing.
Money printing. Yeah, exactly. It's like, you're like, all right, you need cash. You need to raise money to cover losses. What do? It's like, we're going to buy your mortgage-backed securities. We're going to buy we'll buy anything you want to sell. Just don't sell these high performers and stuff like that and tank the market. Yeah. So like they provide that liquidity to cover these short positions. If people get in trouble, your hedge funds, your big banks and things like that, the Fed will step in and they will just print till
but then it just keeps going with more inflation, more unsustainable business models that should not be allowed.
Yeah, exactly. So, but that's what we're saying. Like they're not going. They don't let those things correct. But it's going to be what that tool has worked twice now. And like, but eventually you can't keep using that tool without having problems.
Well, that tool will need to get bigger every time you use it.
Yeah,
now.
And then you also have create stagflation to where you have rising inflation and rising unemployment, which until the 70s or 80s, right? That's when the 80s, like they didn't think that could ever happen. And it's like, well, no, it can't happen. And it's like, could something like this happen? So who knows what's going to happen with the next one? But it's one of those. There's plenty of liquidity, and there's like big investors have more money, more assets than they could ever even imagine. Yeah. That it's like, they sell them off, but they have so much cash to cover things that it's like.
And that's also causing so many more people and big institutions to get into residential, to get into houses, to get into real estate even further. So I think as far as like the housing boom goes, I think potentially, if nothing crazy happens, I don't think this thing is getting smaller. I think it's only going to get bigger, you know, because you're going to have these large institutions coming in with a shit ton of money, you know, because they have all these millions of dollars are being dumped into them because people are like, hey, I have money, put it to work. That's like, I don't even give a damn if we're overpaying for these homes. We need to put in something a little bit more secure, right? And one thing that a friend of ours told us is how insurance companies, they're required to have a large percentage of money on hand, and they're not allowed to invest it in anything other than real estate. So it's like now you have large institutions that their only avenue of protecting that kind of cash against inflation is to put it in real estate. That my theory would be more of like, I think as far as real estate goes, commercial, you know, apartment buildings, everything like that, it's like, I think it's going to only get hotter.
Yeah, real estate, I think it's been very clear if you look at the policies that are putting out that it's like the current administration, prior administrations, the whole U.S. economy is like they are very, very, very bullish and will do anything and everything to protect real estate values. Mm-hmm. Because they see how much money is held there, and they learned from 2008 when they let those values crash, how that trickles through everything across the entire market. To where you have, I mean, the new FHFA director coming in. You have the administration trying to get first-time home buyer programs or trying to get the generation, because they realize like people that do buy houses do over time do much better financially than people that rent.
Oh, of course.
Across the board. So they want to get people into that. And it's like, because they see it as a safe, secure way to build generational wealth and bring people out of poverty by owning versus renting. So that's been well documented. And I think that is something that's going to continue to drive prices up. And my thing is like, when are they going to just start deregulating value so we can provide these houses for people to be able to afford? Because right now, like it needs supply. They have primed everything ready to go. People are ready to buy, but values are skyrocketing, pushing people out because like we as builders cannot build fast enough. We have so much burden, so much regulation. We're finally breaking ground on our new construction. We've owned it for 4 months, and it was literally because of the government processes that prevented us from building the house. We should be damn near done with it and have it on the market already. But we didn't, because the government slowed us down. The municipalities and the way they oversee things, their antiquated systems killed it.
Well, yeah. I mean, it's something that's like the cities need to come together. They need to start thinking about, all of the issues that are coming down, because if not, you just start going like where Austin is at. That's going from a booming city to almost an unaffordable city, right? It's getting to a point where it's like, I wonder when's enough. Like, when are we going to just stop seeing these people that have that capital to just fucking throw into a property over $100,000, $200,000, $300,000 over the value? And it's like, what does that mean for a market like that? That's one of those, like, I think about '08, I think about Vegas, how it was booming like that. And then all of a sudden it took a nosedive. Where houses are selling for $300,000 and they took a nosedive to selling like at 80. You know what I mean? Like, is that going to happen to a city like Austin?
Well, I mean, Austin is a boom bust city, and I mean the tech sector in general is a boom bust industry.
Yeah.
So it is one of those that, like, and it's. I mean, even happened in 2008. Like, compared to San Antonio, like Austin does go up faster and it drops off faster.
Mm-hmm.
But I mean, it's one of the things though is like the stress levels that this can cause on a city that has this massive boom this fast, and as far as like roads, infrastructure, what that does to taxes, because like they're like, we're trying to keep up and we're trying to raise money, and like so they overshoot to where they overtax, they overregulate, trying to just keep up with this demand to get the services to the public that they're trying to do. It's like, and then you have all kinds of problems that can be caused from that. That, I mean, Austin's traffic is the worst in all of Texas.
Yeah.
I don't think it's as bad as California's yet, but that's also why one reason why California's road system is so terrible is because they had a massive
when
boom
do you fix it?
in the 60s and 70s and they spent the entire time trying to catch up, and then all the regulations that came in because they were trying to keep in, and you have agencies coming out saying, oh, you can't do this, and it slows everything down. And then they just have to build to what is there. It's like, because the private developers, they build, they go, they're gone. And now if you want a highway, it's like, where do you annex this massive football field wide piece of dirt to put a new road? And you can't at that point because it's you got a subdivision there.
Well, it's like, oh, shut down 3 lanes and leave 1 open. It's like, those, even on those highways, those 3 lanes are bumper to bumper at all times. Like, you squeeze that down to 1 lane, people are just not going anywhere. So, and one thing that I remember is we talked to friends of ours that are big investors in Austin, and pre-pandemic, they would say if you wanted to build a house, you wanted to do anything, it was taking you a year before you got through all the regulations, all the bureaucracy, everything, before you could even start doing something. And that was pre all this. And now you're adding all these people, all of this stuff, and you're saturating the city, where even the policies, the people allowing permits to go through and everything like that, I can imagine how overwhelmed they probably are. You know what I mean? Where it's like, now you probably want to build something in Austin. I wonder how long it's taking you before you even break ground.
Oh, and I remember them telling stories of the inspectors just like, we don't like developers, so we're going to make it, you guys are pushing these prices too damn high, so we're just going to make life tough for you. I'm like, that is the opposite thing that you should be doing if you want prices to come down. It's like the developers, we're a product of the market.
Yeah.
Like, we are here because home values are what they are and the demand is there. It's like, you limiting our ability, making it hard for us, only further restricts the supply to fuel a demand. It's like, it starts with the demand and the supply comes after that. So now that the values are even higher, it's like, is that even getting worse?
Well, another thing is that they put developers and like big commercial style development all in one bag, right? And it's like, housing development is not the same as commercial development, nor should it be treated the same. So I was actually reading an article that San Antonio's Grand Hyatt proves the city subsidized development isn't a winning strategy, right? So they're talking about the city subsidized development isn't a winning strategy because of the Grand Hyatt. That's like, that's a hotel. That doesn't, that's not doing anything as far as any other type of development that's, housing, shit like that. But are you putting all of these regulations in the same bag because of the hotel? You're going to hurt also regular developers that are developing houses and living.
That's a good...
And in the article, they say downtown folks wanted development. So the city did things like expand the convention center over and over. It also subsidized hotels, lots and lots of hotels. Then city mayor Julian Castro gave us the decade of downtown, which included lots of heavily incentivized apartments and condos at prices only some San Antonians could actually afford. Since the 90s, city staff and consultants argued that what San Antonio desperately needed to go along with its then expanding Henry B. Gonzalez Convention Center was a new hotel. And not just any new hotel, a big one. 1,000 rooms, maybe 1,200 rooms would do nicely. City staff promised a hotel deal was a great one, and that the promise of backing the bonds used to fund its construction with the 2% citywide hotel tax was just a formality. Grand Hyatt opened in early 2008, just in time for the recession to clobber the national convention business. Its performance never met the forecast, while keeping occupancy and average rates down at other large downtown hotels for almost a decade. And then came the pandemic. The convention business evaporated and the fortunes of convention center hotels like the Grand Hyatt nosedived. The city was forced to use its cash reserves to make the debt payments in July 2020 and January 2021. It's time for this community and its elected officials to realize that not all development is a positive. We also must understand that not all consultant studies are reliable forecasts of the future, and not all reassurances from the city staff are credible. If the big projects need a big public subsidy to get off the ground, it may not be sensible. So that was the article. That was the article has a lot more stuff in it, but you can tell the person writing it was very pissed about the situation. They used a lot of things, and it was kind of amusing to read.
Well, but, I mean, to go along with that, so I mean, what to sum that up, like they're wanting more subsidized housing, or what are they really?
They're asking for less subsidized development.
Less subsidized development, but they're also mad at like commercial development.
That's what I'm saying. Like you can't, because you see how in the article they talked about, condos and subsidized condos and things like that. And they brought in the Grand Hyatt in that same conversation, where to me, it's like, that should not be in the same conversation. Subsidizing a hotel should not be the same thing as subsidizing housing.
Well, whoever wrote that article obviously doesn't understand how real estate and business
isn't
works.
That most of the politicians in the city, though? Most of the people there don't understand how real estate
I'm saying, like, in the sense that, like, the public, where, like, housing prices or economies don't expand unless business expands first. So subsidizing convention centers, subsidizing hotels, subsidizing those things, make a beautiful downtown, makes people come to the downtown. That makes your houses not worth. You see so many houses near downtown in the last 2 decades that were just, complete, absolute, utter shacks and eyesores on the city. And I mean, not to be like malicious about it, they were. We bought a house literally sitting on the ground, and people were peeing through the floorboards.
Yeah, no bathroom, and 3 guys living in it. They didn't have any
bathroom, and this was within a mile of downtown.
With bullet holes in the door.
Yeah, bullet holes in the door as well. So it's like, that's what you get when you don't have business downtown. They subsidize the business, people move downtown, businesses move downtown, and San Antonio still has a long way to go. And then that brings up housing values. Yeah. What now the detriment to that is when you combine that with things like historical design review commissions. You have the government boards, you have the public opinion, you have all these things that stop development for housing, and that makes it harder to drive prices up because you've now limited the supply. The demand has been created for housing downtown, but now when it takes absolute just
that makes it easier to drive prices up, you mean?
It drives prices up. And said, like, we want more affordable housing. All these people are coming and driving prices up, and like, we need to slow this down and talk about it. Like, that has the exact opposite effect of what you're going for. It's like, it's going to drive prices up. What you need to do is you need to subsidize more things to get more supply to the area that can stable off these massive price increases. Yeah. And it's like, but everyone just focuses on prices are increasing. We can't be having this. We need to slow this down. Like, no, you trying to slow this down is what causes the problem to make it go even faster.
Well, I think it's just that lack of education, because you hear sometimes the bills and the stuff, like, let's say, you're coming out with something to subsidize better housing, and somebody comes up with this argument. Oh, but look at what happened with the Grand Hyatt. It's like, nobody's talking about the Grand Hyatt. that has absolutely nothing to do with housing. Well, we subsidize development. No, that's development on a freaking hotel. Nothing to do with housing.
Yeah.
Different problems.
Well, but they attack it now. So I have an
Exactly.
article that came out, and when it came back around, I was like, oh, I remember hearing about that 3 years ago. So you have this massive building that when we were working on our downtown house in that area in Denver Heights, there's this massive Fredericks Ice building that is this huge, dilapidated, rundown, just concrete structure that hasn't been used in decades. And it's just sitting there. It's this massive, broken glass everywhere. It's been tagged up. It's just this huge eyesore of this abandoned building. It is useless and then they had this project come out that says they're going to tear that down and put apartments there. A huge complex because, it's on acres of land.
It was going to be a huge mix use, right? Like it was going to have culinary shit.
It was going to be everything. It was going to be 358 residential units to the area. That's huge for that area and that development because it would mimic something like you see coming off North Broadway coming out of downtown where you have all those developments and Broadway's
homeless camps.
No, not on Broadway. That's south of there.
Okay.
But they proposed this article and they have the city developed this trust fund for things like that. But that is a riddled government agency. So the Dallas-based Provident Realty Advisor plans to transform portions of the former Frederick air conditioning property at 1617 East Commerce Street into 358 units, residential units. The project involves a public-private partnership with the Housing Trust and equity partner American South Real Estate Fund, which joined the project last year, signaling movement for the project that had been proposed for several years. So they've been trying to do this since 2018, and they still can't get it. And there's finally getting approval for things like that 3 years later. Now you got housing prices driving through the roof because they're like, oh, we need affordable. It's like you waited 3 more years and you just made things more unaffordable because you're not supplying getting the units. So the San Antonio Housing Trust Public Facility Corp. on June 8th delayed its decision on whether to grant final approval for a long-stalled East Side project to obtain $63.3 million in permanent financing from the U.S. Department of Housing and Urban Development. That decision came as members of the development team said that any delay in the approved process could put the relationship with the equity partner at risk. Luckily for the project, the Housing Trust was able to meet the June 14th deadline. In that meeting, more than a dozen residents spoke against the city-affiliated nonprofit involvement in a largely market rate project, which excludes the developers from property taxes. Some said it would lead to gentrification and displacement in the community. Housing Trust Executive Director Pete Alanis said the organization's renegotiated its deal with the development team, reserving an additional 10 units for residential making less than 60% of the area median income, as well as adding a fee that goes back to the trust when the property is eventually sold. District 1 Councilman Robert Trevino was the one board member to vote against the project. He said that with the growing value of property surrounding downtown, the Housing Trust should have further conversations about whether it should be helping to fund such a property that may boost housing costs around it rather than contributing to more affordable housing. And it's like, well, there you go. You stalling and not talking and not getting 358 units to the house is going to increase demand or limit supply when there's a massive demand for housing.
And what a surprise that Trevino is against it.
Yeah.
My God. Does that guy do anything useful?
No. Well, he wants to run for mayor, so he's trying to do everything to go after. He's trying to appease to the renters.
But then they talk about gentrification, right? It's guys, I'm sorry. I get it. It's a nice little buzzword to use and all that, but it's like you cannot have a vibrant city, a vibrant downtown when you start getting the types of restaurants, bars that are going to open up to cater to that and everything. The people that are living there that essentially won't be able to afford to even enjoy those amenities. You understand? Because even if you could just afford to stay there in your house, you won't afford to enjoy the neighborhood, right? There's probably going to be a Whole Foods that's going to open up soon and some other, like hipster, like Whole Foods kind of thing that open up in those places. That's like yeah, whatever, expensive ass food for no reason. And it's like, that shit happens. Like that's the only way cities, it's not developers, it's not investors that cause gentrification. It's the city that causes it by wanting to revitalize an area, by wanting it to become more vibrant, more people, more density. Like you cannot have it both ways. it's impossible because the only way that makes it vibrant is money. You need to bring in money to the area. If not, businesses won't go there. Restaurants won't open up. And if you can't bring money to the area, then you can't have a vibrant downtown. So, and the people that are living there that won't be able to afford to live there anymore, they're not the ones that are going to keep that vibrancy going because they won't be able to afford to be there. They can't afford to have the businesses that need to come into the downtown area come down there because it's like they can't afford that kind of bougie shit. So it's like, how are you going to get it?
I mean, and then we have a project that haven't talked about in a while. I mean, as a question from one of the listeners, Jackie put on here, it's like, hey guys, appreciate all the content you guys put out there. What are y'all think thoughts about the Lone Star redevelopment and what it'll do to that area? I was like, I think the Lone Star district it needs some kind of push because you look at, I mean, the prices are rising over there. We know somebody just sold something in that area as a 700 square foot house and sold for $240,000.
Insane.
But it's one of those, because of the development in there, its relation to downtown, that if that development does go through, it will be a huge economic boost to that area because of that property and the assets that it controls. I mean, it's like 36 acres in the downtown core of these rundown buildings that if you turn that into an entertainment district, like they're talking about doing, the bars, restaurants, housing development, just look at the Pearl, like case study, 2008 people, or before 2008, 9 and 10, like when the billionaire bought that house and redeveloped it, that was a run down turd of an area. From what I wasn't here, but from what I said, remember people telling me like, oh yeah, you didn't go north of downtown, you didn't go east of downtown, you didn't go west of downtown, you went to downtown to be downtown. You didn't go anywhere else outside of downtown because it was so run down. That's why Julian Castro put it the decade of downtown and put all the money into the city core, bringing people back downtown and creating these incentive projects to where if the Lone Star was to go through and they were to get development, but that project's been stalled for quite some time, it's changed hands like 3-4 times, it would be a huge boost for that area and south downtown, and turning it into a area that people want to be in, want to spend time in. And the housing prices in that area would redevelop that entire neighborhood and that entire section of downtown, something that would rival, I think, the Pearl, because it's bigger. It's bigger than the Pearl. The Lone Star District is, I think, is twice the size of the Pearl. Even
the river access that they have down there and everything, it's nice. Like, it's not an ugly river. You have beautiful homes. And what's that? That historic area that's
King William.
King Williams. You have the whole King William district, everything.
And Lavaca and everything on that south side.
Well, not Lavaca, but like King Williams, you have these beautiful, beautiful, massive homes right there. Like, it's a really nice area. You know, I do like that area. I think if they redevelop the Lone Star, I mean, you're talking about like, that's a very vibrant area to be in. It's going to be very nice because you have the Riverwalk, right? And ever since I've been here, like anybody that's from San Antonio, they're like, the Riverwalk. Oh yeah, I haven't been to that in like years, because to them it's like it's a touristy place. The restaurants suck, you know, like it's always busy with tourists and everything. So it's like, who cares? But now with San Pedro Creek development and then the Lone Star redevelopment, and then if they do, they actually break through with this one on off of, what was it, East Houston, right? That cafe, it was that acres that you were talking about right there, right? With the cafe, what the of nature is that cafe called? Downtown. There's only one cafe we always go to. Oh my god!
Oh, across the street.
Yes.
That one's underway. That's being redeveloped. Okay. That's
with those developments. I think those are more for the people that live here, than for the tourists, right? Like the Riverwalk, I think it's going to stay. The Alamo is going to stay for the tourists. But these area, I think, is to attract more people to come down, and the more people that come down, more businesses come down. Guess what? Affordability or making more gentrification and everything, it's only going to get worse.
Well, it's like you're not going to have $100,000 houses down there.
No,
it's like. These houses don't qualify for anything. They can't be sold to anybody because, like, unless somebody has $80,000 in cash, but somebody buying an $80,000 house downtown to live in, that person doesn't exist. So they're going to buy. It's going to be investors that are going to buy it that are searching return, and they're going to buy it fixed up, get it qualifiable for financing again, and sell it off. Because a house sitting on the ground with a hole in the floor and holes in the roof, no bank is going to lend money on that, and that's what people in that kind of class can afford. But it's like nobody's going to lend money to them because they don't have credit, they don't have cash, they don't have assets. I don't know what you keep doing over there, but quit pinching your fingers. Oh. It keeps happening. John's the type of person that something's hot, he touches, goes, ooh, that's hot. So what's he do? Touch it again to make sure it's still hot.
Eventually I'll be able to deal with it.
Yeah, eventually, I guess. But that's going to keep happening. So to Jackie, to your thing, like, what do I think that Lone Star redevelopment's going to do is I think it's going to just look what happened to the Pearl. Like, it took that into a beautiful area that we're like, my girlfriend and I, we love going to the Pearl. I think it's a beautiful place. So the problem now is like, it's so popular that it's now like, ugh, I like the Pearl, but it's just so damn busy. Every time you go, you can't park there. You can't do anything. It's like, now it's becoming a burden, but it's like, so that shows that the demand is there. And that's been part of the problem with the Lone Star District, because it is twice the size of the Pearl District. It does take twice the money to do it. And they don't have some billionaire person that created Pace Salsa coming in and buying it cash and redeveloping. They got to do it with debt. They need projections. They need to show the studies that, hey, this is actually worth it. And it's not a place that, like, you can only fix one piece of it at a time. Like, no, it's a lot. And they have to do it in big, large phases. I mean, the good thing is they do have a great, local developers behind it now. It's not some hedge fund out of California with some partnership out of New York. They've partnered with, I think it's Gray Street is who's now a part of that.
Where the biggest? It's like Gray Street and Western
Urban.
Yeah. Well, I think that's also another thing is like there's so much pent up demand that all the stuff that they even have in projections now, it's like, you're still behind. Like even that, all that shit, like as soon as it gets done, I think it's going to be gone in 2 seconds, where it's like, you need more. Like this isn't enough. The amount of people that we're having and the overflow that I think San Antonio is going to be seeing from Austin is going to be beyond insane.
I kind of still hype on it. Where like San Antonio has so much room to grow. Oh, tremendous. Because like and it goes down to our infrastructure systems. Like one thing the government did right, but it wasn't the reason. It's just a side effect of it is like the way they built our roads after World War II. Yeah. And before, because right now you look at Austin, it's like they're building roads once the developments are there, which makes it a lot harder to build the roads that are needed. But here it's like they built the roads first and then development came around them. So now you look at 1604 on the north side of the city, it's like they can double the width of that road, like all the way along it. I mean, but our major feeder roads are kind of maxed out, but it's also, our rush hour. Like I live 12 miles from downtown at 8 o'clock in the morning, can still get downtown like 15, 18 minutes. Mm-hmm. Name one other major metro that you can do that kind of commute anywhere.
Well, and then that's also the thing is like we have so many other options to get across the city other than the main highways if we needed to. You know what I mean? Like even if you take like inside roads like San Pedro or Broadway or everything, you have lights. They don't last all that long. And you don't have that dead stop traffic anywhere, right? It's always like it might be just moving slowly, but it still chugs along. Yeah, so even the dead stop is probably like not even a quarter mile worth, and then it opens right back up.
Yeah, it's like Hildebrand's the one exit that slows things down heading downtown.
Yeah, well, because of the freaking funnel they have there. But one thing that I did want to touch on is I wanted to really, before we keep moving with these articles, is I wanted to kind of break down because the quarterly market update is coming out now, and why is it that we do a market update? And how is it that we look at a market update? When we pull data, when we pull all this stuff from the market, what is it that we're looking at? Why are we pulling it? How are we using the data? So I wanted to really cover that because there's a lot of people that they like the market update, yet they'll text me later and be like, hey, so what are some good zip codes? And I'm just like, we're giving you the information, but they don't know how to use it. They don't know how to combine the information. So I wanted to really make sure to put that together in a way that it's like, this is how we do it. This is how it works for us. And hopefully this helps you guys listening. So if you have any questions while we're doing this, put it in the chat below and we'll make sure to get to those questions. But for me, the biggest reason when we started doing the market updates is we used to go to RIA here, and the owner of the RIA, she used to put the market updates, and she used to talk about the hottest zip codes and all of that. And then we stopped going to that RIA, and to a point she had stopped doing that for a while.
Well, she had a vendor putting it on that actually gave a great report, and then that vendor no longer, they had a falling out, and then they stop with the report.
Yeah. So, but it was still excellent data because we used that data to choose where we were going to be marketing. So that's when you started pulling that data together, and you figured out how to do it, how to use all the resources and everything to pull that data. And it's been helping us ever since. Every time we're going to be investing, every time we're going to be buying, we know if we're going to move on a property fast or not based on the market updates that you do. Because based on that data, based on the prices, based on everything, we know where we're going to be in this market. We know the market very well. And when we start branching off to other cities and other states, we're going to be pulling the same exact data because we're going to be determining what spots are the best spots to be in. Mm-hmm. So with all that being said, the biggest data, what is the data that you actually need? Not how to pull it yet. We'll cover that after. But what is the data that you actually need when you're pulling a market update to determine what neighborhoods, what zip codes, what areas, what price points? What's that data look like?
Well, I mean, a lot of it is everyone here talks about months of inventory. And when you hear us all talk about supply and demand, there's too much demand, not enough supply. It's like, and that relates to months of inventory. So your balanced market is somewhere between 6 to 6.5 months of inventory. I've never seen that market because it's been below that ever since.
Right.
But that is where they say the equilibrium is between buyer and seller, to where you have your average appreciation of 2 to 3% in housing prices. No buyer or seller has any negotiating power over each other. That's where you get your balanced equal market. Now, anything below 6 months of inventory, and the way inventory is calculated, if you look at the rate of consumption, say on July 1, basically, let me rephrase that. The number of houses that sold in the month of June. Say there's 100 houses that sell in the month of June. And on July 1, how many houses are for sale? So now that puts a benchmark of like, all right, this is how many have for sale, and this is how fast houses sold. And that tells you your month's inventory. So if you have 100 houses that sold in June and 300 houses available for sale in July 1, that means you have 3 months of inventory. So if the same rate of consumption continues, how many months would it take for you to consume all of your inventory? So to get to a balanced market, you'd have to need to have 100 sales in June, and you went from 600 to 650 houses on the market for sale in July to have a quote-unquote balanced market. Now, the problem like that is right now in San Antonio, we have 100 houses that sold in June and only 120 houses for sale. So that only leaves 1.2 months of inventory on the market, which means that there is massive, massive demand and not anywhere near enough supply. So you have a lot of buyers fighting over those houses. So when you have those low months of inventory, that drives prices up. And that means that people are willing to pay more. You have bidding wars that are ensuing. You have people paying, like in Austin, their example is they have 100 houses that sold in June and only 50 houses for sale. Yeah. So that's how you get 20, 30, 50, 100, $300,000 over asking prices, because the biggest buyer with the most cash is just like, you know what, I'll take whatever it is and I'll bid it out and I'll pay for it to get it. So that drives housing prices up. So when we do our market updates, that's what we're looking for, is those imbalances. Like, where is the most in-demand price points and zip codes that has that month of inventory based on a sales volume? Because also you can have very low inventory to where it's like, you look at the $1 million mark and it's like, well, you only have half month of inventory. Yeah, only like 10 houses sold though.
Yeah.
So it's not a lot of demand.
Well, and then I think something very important to keep in mind when you're talking about that is, if you're not in Texas, you don't have the privilege of getting the market updates we put out, because we only focus in the Texas market right now. But if you're not in Texas, when you're determining, hey, is this state, city, town worth me investing in? That's the first thing you need to look at. Because if you want to determine, where's this market? Is this market hot?
It's easy information to pull. To where you could ask,
and we're going to cover how to pull the data.
I mean, and just in general, we'll cover that for here. But like, if you wanted a basis quick tip to that, call any realtor and say, hey, over the last 30 days, how many houses sold in that market? The last call, just every single house, single family houses, how many sold? Yeah. And how many are for sale today? That's all the number.
The realtor says, great question. Probably don't work with them.
Yeah. Well, I mean, it's simple MLS search. You can get the basic data just to get a basic months of inventory is like, is this hot right now?
Right.
To where, and then you can break into that data a whole lot further. But that's a quick way for a quick analysis of any city, any metro, any certain section. It's like, I just need how many houses sold in the last 30 days and how many houses for sale today. Those are 2 numbers you need.
So to compile you need the months of inventory. In order to get that, you need the number of sales, right? So you can get that, you get that information, you understand what the months of inventory are. Then some other data that you pull is median price. Why does that matter?
Well, I like the median price because that just shows like where is the middle ground, like where is your median house that everybody can afford. So then I take that information and we use that as like, okay, that's where the median price is. So I mean, you got half below and half above kind of price points. Like I want to buy below the median price point because now that shows that like, hey, and then when you look at the months of inventory number sales, the numbers agree that, or in here in San Antonio, the bulk of our sales, like a third of our sales are below the median price points. And the highest months or the lowest months of inventory are still in those zip codes. So when you have high sales volume and low months of inventory below the median price point, it's like, that's where I want to be marketing because that now makes it a much safer bet on our point. Cause that's what investing is. It's all a bet that, hey, this is going to be a good investment, that prices aren't going to fluctuate too much on me to a negative. Not going to go down because it shows there's massive demand and low inventory to feed that demand. So especially for buy and hold, it's like, hey, if I can buy in the median price point or below those price points over the long term, that means my pricing value is going to go up or my housing value is going to go up.
And why is it that we don't care about average price point?
Because you can have just one massive sale that can just throw that off. It's just like, okay, so you only have so many $10 million houses here in San Antonio. There's very few of them, but 2 of those sell in a month and it can sway that average price.
Exactly.
And by the tens of thousands.
The reason I bring that up is how many times do we hear, especially realtors, they're like, oh, the average price in San Antonio is X. I'm like, that means absolutely nothing.
Well, and it's also our average price is like $390,000, but our median is like 300. Right. It's like, I want to know what the median is. Like, where is the middle ground of the average person buying? Like right in the center. That's what your quote unquote average person can afford is that median price. I can't afford that average because it's like, yeah, because you have these massive sales that just like really can skew those price points.
And that plays the same with why you pull median rents, right? You pull the median rents for the same reason.
Yeah, exactly. So I want to know where the bulk of the sales are for this exact same reasons. Like, I don't want to be buying houses. Like, how those numbers can skew if you don't know that. It's saying like, hey, look, the $800,000 price point has really low months of inventory, and the $20,000 or $4,000 a month is the exact same. It's very low. It's like, so that should be a great price point to buy. What you're not paying attention to is like, no, but you only had 50 houses selling that price point when you had 600 selling lower, and the same thing for the rents. It's like only 40 houses rented for that amount. It's like that doesn't make a massive demand. Yeah. It's like that's more of your average price point. That's where an area that can be very volatile. It's hot now, but like a few people drop off, those rents are going to have to fall, and they don't fall. $25 off a $4,000 rent does not make a bit of difference. Nope. It's kind of like we talk about those high price points. If you're like $800,000 house, dropping the price $5,000 doesn't make a bit of difference. But in the $200,000 price point, in the $1,400 rent price point, $375 makes a big difference. 200 to 205, or other way around, 205 to 200 makes a big difference in showing demand. So now you get a whole nother price point of people that can afford it. So that is why you have to understand those numbers and what those actually mean. That's why you can't just focus on just one piece of data. Yeah. You got to dig into it. So like I said, you ask those realtors to get those numbers and you say how many sold. So now you can kind of break down and dig into price points and things, but that's a great way to see like, is this hot or not? It's like, I just want to know the number of sales, to where if it's a very low number, but the price point or the month's inventory is low, it's like, yes, you have the demand now, but there's not a lot of people that are buying. Yeah. So there's only just a few people buying in that market.
So make sure you're subscribed to this channel because as soon as we release the market update and everything, you will be able to get it. And you will, even if you don't live in Texas, you'll at least get a very, very good idea of what it is, that data that we compile and everything, so you understand it if you need to pull it in your area, your city. What are other data points that you are looking at when you're pulling the market update?
Some big things that, I think are precursors to housing market is unemployment. to where if you have high unemployment, that's why a lot of people they got it wrong, but they had their analysis was right. Is like unemployment went through the roof. It's like if people don't have jobs, they can't get mortgages.
Right.
Like if you don't have a W-2 income from a job, like you're screwed for trying to get any type of financing. And that came after the wake of 2008, which I think was good. So that's why everything we're happening now is because when the shortages we're having, and when it all started, unemployment through the roof, everybody went home and locked down. Mills stopped investing. They stopped planning because builders stopped building because they're like, crap, we're going to have a massive recession now because like nobody's going to want to buy houses. Look at all this unemployment and stuff like that. Nobody thought the government was going to come in and do the things they did, and you had the opposite effect. But that's why we're having those problems. Like they follow these unemployment rates. But that is another reason that I do track those things is like, I want to know what the overall employment rate is doing as far as not just the employment rate, but the number of jobs that are being created. Is our population growing? With that, is the number of jobs being created? So I don't want just a stagnant job market and just people going to work. It's like, I want to see new jobs created along with a growing population. There's nothing worse for real estate values than a declining job market and declining population. Because then it's just like there's people leaving. You have supply of housing and there's nobody there to consume those houses. Mm-hmm. So that can cause prices to fall. So here in Texas, we've never lost. I was just looking at this the other day on one of our sources as comparing to like, okay, look at our Texas markets compared to like, say, a California market where California's population has declined in the past and it currently is like just barely, it's stagnating to where that can be detrimental to real estate values over the long term. So that's another thing you want to continue to see is a long-term projection of growth in population and employment. And then the unemployment is your short-term thing of like, hey, where's the unemployment rate right now? And if it's starting to tick up and you can't find anything in the market of like, why is unemployment rising? Yeah. So that it would be a concern. At least this last time, it's like, we knew what did it. It's like, we knew there was a problem and you fix that problem and it goes away. You get a vaccine out, that should go away and you should normalize things.
So any other data points that you like to look at? Anything else other than like those seem to be the most important ones?
Those are the big ones for sure. But new starts is like, that's your home builder confidence aspect of it. Are people, because like builders, it's hard for us to get money. We don't qualify for any of the like the EIDL loans that kind of came out, the economic impacts that they're not favorable to developer, which is another reason we have problems financing. Cause like it is a big risk for a financial institution to come in and saying like, hey, I'm backing this asset for you, but you are a major linchpin whether this is successful or not. That's why you get low rates on a house. It's like, okay, there's an asset there that you default, I can get the house back and I can resell it to somebody else. But if I'm lending on raw dirt and land and materials and you go bankrupt and stop paying me halfway through your development, the bank can't step in there and, I got a whole team of people that can just go and finish the development for you. Yep. It's not how it works like a house where it's like, a house is done, I can foreclose on, I can sell it off. So for us, that is harder to do. So we are a product of the current market. So I do like to watch what are the new development permits being pulled, because that shows that investors are investing in the market. They do believe in the housing market. They do believe in where the industry is going and they feel good. Now that can turn on a complete dime like we saw in April right now, because when you guys pay attention and watch the market update, our year over year growth in permits is through the absolute roof. But it's also, you look at April, and a lot of the data is based off of April, May of last year, which is right as the pandemic was started. So it was the absolute when everyone just froze. So now we're going from freezing to booming. But it's one of the things you kind of watch over term, kind of go back to previous times to see, is the market expanding? Do builders feel confident in spending the money? And we're a very cautious industry because we got smacked around so hard by 2008 and saw so much economic pain come from that. So you kind of can get a slight gauge on that, but you got to kind of take it with a grain of salt. So it's not a primary thing that we look at, but it is something that we look at.
Well, and that's something that why it's so important to be able, we archive all of our market updates, everything, because that way you can actually go back and compare month over month. Like in this point, like we talked about when we do the market updates, year over year makes it difficult because of 2020 being such a crazy year, a lot of shutdown, a lot of fear, a lot of everything, that it's almost something like, should you start comparing month over month, quarter over quarter, to see, are we speeding up? Are we slowing down? Especially like this coming quarter is going to be the most important quarter, in my opinion, because we're moving into the hottest time of real estate moving. And it's like, what's this quarter going to do? Like, are we going to move faster than this quarter two and quarter one? Or do we start seeing a slowdown? And then we have the winter months. What is that quarter going to look like? So it's going to be interesting.
Yeah, definitely. That's what we're going to start looking at, is because really June last year is when like the boom started. And so now as that data comes out, that's the information that I'm now going to start comparing year over year, is like, are we continuing pace to when things were really hot last year? So where do you get this data? I get this information from the MLS is a gold mine of information. The thing is, like, you do have to be a licensed real estate agent or know a licensed real estate agent. And then you got to find a licensed real estate agent that's willing to pull this information for you. And you get that from the MLS. And that is an importance of like working with somebody that understands this or pulls it themselves already, because it does take a lot of time to download this information and break it apart. I mean, we've outsourced a lot of that work to overseas because it is very, very time intensive. I think it takes them 2 days just to pull the information and separate it into the stuff that I put into that report. And it's 2 full long 8-hour days of just downloading data.
More than that. It's actually closer to 30 hours.
Okay, 30 hours.
The data together.
30 hours to put all that information together, and that's just downloading literally the information from the MLS and separating it out. So it does take a lot of time to do.
And then the time that it takes you to put the actual presentation. Look how much we do for you guys. My goodness. But you putting that information together, the graphs, everything to start, because at first it's all Excel data. It's just data points. But until you really graph it out and you can see the trends, you can see the peaks and valleys, like that's when you get an overall picture of okay, so we hit peaks, kind of like why we make sure that our rents all expire pretty much in March, April timeframe, because we want to rent in pretty much the beginning of summer months.
Exactly.
So we use the MLS. What other data points?
So the MLS, great source. Another one's is there's government websites. I use the Bureau of Labor Statistics to get my unemployment data. That's basically where everybody gets it from, because the government's the only one that has the power to take national stats like that and put them together.
Yep.
The bad side is like it can be significantly delayed. It can be 2-3 months behind. Then it can regularly catch up. Then they can do adjustments. They can do all kinds of things. So that is another site that I use for that. So the Bureau of Labor Statistics is a place that you can go, but I mean, you start into those websites and they just turn into just information that just goes all over the place, and it takes a while to understand. And the Fed sites are another good ones. So those are government websites. So you have like the Dallas Fed, the St. Louis Fed, San Francisco, New York. Those federal sites, they track things like national interest rates and then consumption of certain aspects that you can kind of use. But another one is like, it's a grain of salt kind of research you're doing there, or it's like one thing that could show you're tanking, but it's like, well, that has a very small effect on this stuff. But if you can put your own analysis together, I mean, it is very beneficial. So government websites are another place that we pull that information from.
Yeah, and there's one, I think it's called City Data, like city-data.org or something like that. You'll get a lot of demographics. You get a lot of like medium household income. You get a lot of stuff like that. It's just like John says before, it's not always the most up-to-date data, but at least it gives you a decent idea if you're thinking of branching off into a new market. So where else? What other areas?
We have here in Texas, we have called the Texas A&M Real Estate Center that puts out a lot of information. So I do pull a lot of stuff from there as far as that's where I get my building permits, like to see how many permits are pulled, what is population, what is inventory, and they have their own information there. So using those kind of websites is great. And I mean, even they have national stuff on there too about the big MSAs. They compile data from all over the nation. They have the most detailed stuff in Texas for sure, but they have national information as well that you can go to and pull that information and that data from.
Okay. And anywhere else? You did talk about calling a realtor. So, I mean, one of the data points that I've seen that I used in the past, how I picked San Antonio, is real estate agencies, Keller Williams, your big ones. You go and a lot of them do put out market reports. They do it more on like a quarterly basis. They may not go in as much detail as we do because we're looking for investments. We're looking for specific things. But there are a lot of them that if that's all you got, that's still,
Well, I mean, it's kind of funny. You go back like 10 years, I feel like, or even when I started this, like none of them focused on months of inventory. It was all just days on market, days on market. And now you look at all the major metros and like what they put out months of inventory for their area. I'm like, finally caught on that that's the number you should focus on. I think the days on market was a sales tactic.
There's a lot
for
of people
that
copy us.
But
yeah, so local agencies, realtor.com, I know they put out, and there are sometimes they put out a lot of stats that I'm interested in. Like sometimes they put
here's a good resource. It's called GOOGLE.
Yeah,
doing research.
Yeah, if you go to Google and you just type in your city, real estate market data, updates, stuff like that, you should be able to come up with the results of different resources and places like that. And if you live in Texas, the best resource for this is
this guy.
Yeah.
These guys right there.
Boom. But yeah, on our channel, we do very comprehensive detail. And not just that, but one thing that you do excellent every time you do the market update is you break down different things for people to understand better. So you've broken down months of inventory before. You've broken down, why we choose to lease our properties at certain areas, certain time frames. So that, I mean, you're getting literally how we put this together for everything. All right, this is literally, we're not holding anything back. The one thing is like John said, it does take a lot of time. We do have a VA that pulls a lot of this for us because, John's been able to put a whole system around this, but it still takes him like nearly 30 hours to put all of this data together. Now, the next topic that I wanted to hit is how is it that we use this information? How do we use, once we pull it, we pulled all that data, and you kind of been covering why it's important and everything, but how is it that we use it, right? Combining things, using different data points. What is it that we look at?
Yeah, I mean, it's all of those things. I mean, the month inventory, the sales data, the stuff we just covered. I'm not exactly sure what you're trying to get at there.
Well,
exactly.
One of the things that I use specifically, especially when we look at what market we should be in and everything, is like you talked about at the beginning. We take the median price point, right? So we determine, all right, this is the median price point. And based on that even median price point, one of the data points that you pulled to is what are the hottest sale prices in this market, right? So you have ranges, like on the market update, you'll see between 150 to 200,000. It's X months of inventory, 200 to 250, so on and so forth, right? So you see that and you say, okay, these price points have the hottest months of inventory. So now you start saying, okay, which are the zip codes that are the hottest zip codes? So now you find those zip codes, and one thing to keep in mind with the hottest, and we have the hottest and the worst zip codes. One thing to keep in mind is that there are bad areas in hot zip codes, and there are great areas in bad zip codes, right? So you have to be able to pinpoint to the neighborhood based on the prices. So if your house is maybe we always had it when you talk about the worst zip codes, and we used to do this live in a group area, and you see people's faces like, oh shit, I have a house there.
Yeah.
And it's like, well, yeah, but your house happens to sit perhaps in one of the good neighborhoods in that zip code. It's just the zip code overall. And San Antonio has a lot of zip codes.
Well, that's also why you don't just look at an area and just a zip code. It's like you look at a price point and a zip code.
Yep.
Like you got to have both. And then you got to pull the neighborhood and see like what's my inventory in my immediate area and what are they paying for? Because like we have a house right now that we're looking at. It's like we're having a hard time comping it because it's so much smaller than everything around it. All the prices are sky high, but for houses 500, 600, 700 square feet larger. So like, well, what's that put a value at our house? It's hard to determine.
Yeah.
So, but that makes us feel confident. It's like, well, that means nothing is selling at our price or for our square footage. So that means we could probably command a pretty high price for it. Not as high as 700, the house is that much larger, but we're going to have a pretty higher price per square foot because we are smaller and there's no inventory for those price points.
Right.
So we definitely do that. You have to pull your information for your immediate area. It's like, what are people willing to pay and how much inventory is there in that area? Because you can find new neighborhoods right next to houses built in the 80s, and now you have 2020 builds. It's like, well, a 2020 builds are selling for $320,000. Well, that doesn't mean the 1980 build right across the street is going to sell for $320,000. It's like apples and oranges.
Yeah.
It's like you're still a housing market, but it's like it's a brand new house that's going to sell. So you can't sell you command that price when you're across the street or for older housing styles. So you have to look at those things and analyze that specific local area to that house. So you got the zip code, you're in the right zip code, you're in the right price point. You still got to check the neighborhood. More time, 9 times out of 10, if you've got those two things, you're going to be all right. But you do want to check, because there is one neighborhood that over on our far west side, you have this pocket of just really dilapidated, rundown houses, and it's surrounded by an area it's in the right price point, in the right zip code. It's probably finally bled over, but 3 years ago, it's like if you just looked at that, you'd be buying a lemon, and because it was just a terrible area, and there was a stigma around that neighborhood after the 2008, after the Katrina hurricane came through, that it really pushed a lot of values down for that specific zip code or that specific neighborhood, to where you had good
Talk about
parts
the east side.
Yeah, that's what I said.
You said the west side. You and your east and west. I'm and the whole time I'm going through my head. I'm like,
sorry,
what neighborhood on the west
east
side?
And west. That's dyslexic towards that, and I've always been. So I'm talking far east side. There's some zip codes, some neighborhoods over on the east side.
Okay, gotcha.
That you got to give yourself a margin of error.
Well, and it's the same thing. Like if you're looking for rentals. You're looking for rentals, you do the same thing. What is the median rental price? And then you start looking for neighborhoods that meet that median rental price, because you want to make sure you're picking up rentals that are actually going to get rented, that have a large demand behind that price point. And chances are, if there's a large demand behind that price point, whenever prices rise, that price point is also going to rise. That neighborhood, that area is also going to rise, because it's catering to that demographic of people, the bulk of the people. And that's definitely what we do. When we look at rentals, when we look at areas like that, how do we pick the neighborhoods that we want to pick up rentals in, and everything's, we're looking at it. We don't want to be too high on the rents, and we don't want to be too low on the rents, because we want to be in that sweet spot. And that's why all of our, even before pre-pandemic, all of our houses will get rented within like 2 weeks. Every single time we put a house on the market. And it wasn't, yes, we do good work and we do everything, but it's the analysis of being able to cater to a high demand area that you're putting exactly what they want on the market, so it's gone instantly. So your turnover, everything, it affects all of those things.
And so, I wanted to add into like 2 questions we have here on our chat about some other good information that you can use, and that is U-Haul is a good data, as well as like checking prices of like what it takes to U-Haul to go from San Francisco to Austin, Austin to San Francisco, and seeing what those prices are. And like it's the same distance, but it shows where the demand is at. So they're trying to get trucks to go from Austin. They give like $300 to go from Austin to San Francisco, because they need the trucks in San Francisco to move people to Austin, because they can charge $1,400 coming back the other direction. Yeah. So it's another information that you can do. And then you have a question here from Kyle about getting mass zip code information or credit scores for certain areas. I really don't think you can get a credit score average. You can get their credit scores when you're doing tenant applications, and you can get like an average range that they fall in between of where we get our information. Say, hey, we want their credit score needs to be between 650 and 700, and you can give a grade of A minus, or what is it, like D plus, C minus, C, and you can get those ranges, and it'll give you a color, and they fall in that range. Now on a mass area, I don't think you can, but when you alluded to like going to citydata.com, you can look at such things as what is your typical person with a lower credit score usually have. As like, you're going to have lower housing prices, you're going to have higher crime rates, and you can get like purchasing, like look at the number of like used car lots, the number of like liquor stores, casino, convenience stores,
lack of Starbucks.
Lack of like your higher end brands. Like you're not going to find a Whole Foods down in a place where the median price point is 80% or below. So looking at that data, you can pretty much make a bet that, hey, these credit scores are going to be a little lower in this area. And
it's the same why we don't look at when people say, what about the school districts? What about this? What about that? And it's not that it doesn't matter, but when you look at the median rents, the median price points, the hot zip codes, all of that, it's telling you where people want to be. So it doesn't matter, whether what the school district is. None of that crap matters. What matters is that people want to be there, right? So that's what, as a landlord, and the same with credit score. You're saying, but how do you know the credit score in the area and everything? It doesn't matter. If that area has that price point, then that means those people.
If those things make a difference, you'll see it.
Exactly.
Like you pull a zip code and you cross a major road, and all of a sudden you see a $50,000 price point. You're like, something is there. And if you drive it, and it's like these are the exact same houses. I can't figure it out. There's an external factor that you can't see, like a school district or some kind of. It goes from city to county, to where you see there's a big difference in price point. You'll see. I remember this getting in an argument with a broker one time, and you could tell they were looking at it like, oh, this is a great investment because you have the schools, it's near shopping, you have all these things, and it's like, it's going to go up. And like, I told him, it's like, but all of that is already priced into the price point. Like, I've been a broker for 25 years. I know exactly what these things are talking about. It's like, you've been a broker representing retail people, and that's what retail people care about. It's like, hey, I want it because I want to be in this school district. And that's why they think the school district matters much when you do a lot of retail. But when you're doing the investment style, it's like the data will tell you what people want, where you might specialize in that. Your clientele wants that school district, so you think, oh, people want to be here just because of school district. Oh, I can tell you, I go right over here to this other school district, and I see the exact same house for the exact same price, and it almost rented or sold in the same amount of time frame. School district really doesn't matter. Yeah, people want to live in that school district versus this one, but they're fine going to this school district because they want to be in this area.
Yeah. So that I think would matter as far as I think that's a data that definitely matters to realtors, not investors. Investors, whether you're doing buy and hold, fix and flips, anything of the investment realm, you're looking at these data points that we shared because these data points are going to give you that same information anyway.
Well, that's why you have to be, like I was mentioned, you have to be careful with the real estate agent and who they are, to where you can get information from them, but you also have to ask the question in the right way to where they can get you the information that you're wanting.
And you need to be able to read the results yourself, not listen to their interpretation of the results.
It's like, just because you have a real estate license does not mean you're an expert at real estate. It's like most people, like you have a real estate license, so you're an expert in sales. Yeah. In the realm of real estate. To where somebody's a great car salesman, they could probably come into real estate and be a great real estate
And it's the same when we talk about
person.
rehabs and renovations and everything. Like, you can get a GC license. Not that difficult to get a GC license. Yeah. It doesn't mean that you're a good GC. It doesn't mean that you're a good contractor. It just means that you have a license. You know what I mean? That's it. And the same with a real estate agent. It doesn't mean that you're a great real estate agent. It just means that you got your real estate license. You
have sales volume. It's
you
have you're good at marketing,
fiduciary responsibilities and everything. It doesn't mean that you need to abide by them. We see real estate agents a lot that break the rules and shit like that. It's like, it still doesn't stop somebody from screwing up or not knowing what they're doing, which is why you cannot rely on anybody's stuff. You need to understand. And this is why we did this whole part, is for you to understand data, not just because we're telling you this is what it is, means that you should take our word for it. It's like, learn it, understand it. That way, when you're starting to see, hey, man, I'm in Austin and it sucks. Picking up properties here. I can't find rentals. I can't find this. I can't find that. Well, maybe you should branch off to another city. Well, which one? This is the data that you need to start pulling. You start using this data. This is how you're going to know.
And that's one thing, like when it comes to investing, like it's hard to do, but you have to bring your natural tendency to be biased towards a certain thing out of it. You have to get emotion out of it. It's like, it's data driven. That's why it's like, you as the investor, it's your money. You're the one taking the risk. So you're the one that needs to understand how to use this information, how to manipulate it. Don't rely, oh, my property manager says I should do this. Yeah. Well, ask yourself, like, well, how does this information benefit the property manager? Or why is it property manager giving me this information? It's like, what is their motive? Like, everybody does it, like, everybody's got a motive. Everybody's got some kind of underlying motive that benefits them some way, shape, or form. And you need to figure out that biases, to where you have a lot of terrible property managers, but they're some of the biggest property managers in town. But it's like, because they're very good at marketing and they get you roped in there and they're keeping you in those contracts. So you kind of have to ask, like, this information that I'm asking you, like, why are you giving it to me? Even when you call a random real estate agent from some random city and say you want this information, why are they giving it to you? Because they are hoping that they can give enough information to you that you will use them as their service.
And it's fine. It's just, you need to understand, is that information good or bad?
Yes.
You need to determine that. So hope you guys enjoyed this little conversation that we had on how to look at the market update, how to pull your own data, how to do your own analysis to figure out where you need to be. This is going to help you with marketing. If you're going to be doing any driving for dollars, polling lists, trying to filter through certain zip codes so your list is not, 10,000 plus properties. This is the data that we use every time to niche down to figure out our marketing, our strategies, and where we invest. So hope you guys enjoyed that. And if you have any questions about it, keep dropping
Don't go anywhere because we're not ending the show yet. Just saying.
Why are you screaming like a psycho?
Because I just popped in my head. It sounds like you're ending the show.
Make sure to put it below, and we'll get to those comments and responses. And always text market to 210-794-9898, and you will be you'll have access to the zip codes, to the slides, to the presentation, to everything that we put out, so you can see that for yourself. Now, moving on, I have I wanted to kind of touch on,
It's my turn to talk about an article. You said all yours. It's my turn.
Go. It better be good. That's all I'm saying.
It's like the whole start of the show. It's like you were just like bam, bam, bam.
If it's not good, if the article John chooses is not good, I want to see every thumbs down on this video. All right, go ahead. What's the article?
Wow. And if it is good, give us a thumbs up. How about that?
There you
go. One that slipped through the cracks, and I told you about it. You're like, really? I didn't see that. I didn't either. It was like the Biden administration extended the the eviction moratoriums by the CDC, but they did say that it is the final month that they will be doing this. They extended it for one more month through July. So the Biden administration on Thursday extended a nationwide ban on evictions through the end of July as renters recover from the economic downturn caused by COVID-19 pandemic. This is the third time the CDC order has been extended since it was first went into effect. The White House said this will be the final extension, but announced a series of actions it would take to help state and local governments prevent evictions, including accelerating the distribution of billions of dollars in emergency rental assistance and encouraging anti-eviction division practices to state courts. So the move comes after the Biden administration faces pressures from congressional Democrats and housing advocates to extend the moratorium. A group of 41 Democrat lawmakers on Tuesday argued in a letter to Biden that the eviction would take lives and push households deeper into poverty, and that the issue is an urgent matter of health and racial and economic injustice. Around 7 million people in the country are currently behind on their rents payments, according to a Census Bureau survey released in June. So they are extending that. It's like, well, what a surprise. We kind of expect they were going to do that. But it is great to see that they're saying, like, they're telling everybody, we're going to do it one more month, but this is the last time we're doing it.
I'm serious. I'm serious this time.
And I think that is why they extended it only a month, because the last times they did it, they were like, the last two times, like, it wasn't just for a month. It was like 3, 6 months that they kept extending it to where now they're like, I think it's one of those, like, you're giving it an extra month just to tell people, like, hey, you need to get your stuff figured out, otherwise you're.
But I'm really serious this time.
I'm really serious. I'll give you one more month.
I'm gonna count to 3.
I'm gonna count to 3, and you're good to go. So that is something that came out, and look at that. I got 2 likes out of it and 0 thumbs down.
Okay, very nice, very nice. No, it was a good article. When you told me that, I was like,
well, it's just funny how, like, it just slipped by.
Yeah,
made no national headlines. I found it on, and it wasn't even like Housing Wire that covers real estate news. It was just like down the market. It was like, oh. What?
And,
like, where was that?
Who knows? This might be something that kind of lights a fire under people's asses to, like, all right, we need to get back to work, right? Like, they're only extending it for one more month, and if we don't get a job or something, we're probably going to be out on our asses. So we need to at least secure a job, do something, because even landlords and everything, like, if you at least say, hey, look, I know the time was terrible and all of this, but here, look, I got a job. This is my job. This is how much I'm getting paid. Can we make up the lost rent? Can we do something? At least you don't lose your place. Because trying to go now into the market to rent.
That's what I said. My next article here is rents for single family homes just saw the largest gain in nearly 15 years.
Wow.
So, and I mean, it's great for landlords because, like, what rises with property values? Your taxes and your insurance. Where rents don't rise with that, eventually you're like, man, this house is a lemon anymore. I can't sustain it. It's appreciating, but I get no cash flow to repair it. So they sell it to get liquidity. So single family rents were up 5.3% year over year in April, rising from 2.4% increase in April of 2020, according to CoreLogic. This is the largest gain in nearly 15 years. Rents for single-family detached homes, not townhomes, were up an even stronger 7.9% compared to a year ago, as millennials in particular seek more outdoor space. Nearly half of millennials surveyed by CoreLogic and 64% of baby boomers said they strongly prefer to live in a single-family home versus a standalone home. Single-family rent growth showed a strong rebound in April 2021, with all price tiers back above their pre-pandemic rent growth rates, said Molly Bozel, principal economist at CoreLogic. While rent growth slowed last April at the start of the pandemic, the rate of rent growth this April was running above pre-pandemic levels, even when compared with 2019, and shows no signs of diminishing. So, lower priced homes, 75% or less than the regional median, were up 3.9%, up from 3.2% in April 2020. Lower middle priced, 75% to 100% of regional median, up 4.8% from 2.5% April 2020. High to middle price, that's 100 to 125% of regional median, was up 5.1, up from 2.3% in April of 2020. And the high price, which is 125% above the regional median, was up 6.1%, up from 2.2% in April 2020. So all price points are gaining. And what kind of shocked me a little bit is like it's the ultra high priced that's gaining the most, to where it has the largest spread from April 2020 to where like, and so your low priced went from 3.2% growth in April last year to 3.9 of this year. And now your high priced went from 2.2% of April 2020 to 6.1. So you look at that, it's just very interesting. So your low price was appreciating at 3.2% last year, and your high price was only at 2.2.
And what do you think?
But now it's flipped. Well, I think it's exactly the same reason you see higher priced homes accelerating at such a high rate at the same time. Is like the rich people, the people with money and assets, are the ones that are fueling this economy. Or like they're the ones that have options. They're like, you know what? I'm tired of living in this apartment. I'm gonna go rent some really nice, extravagant.
Or they're
house.
moving here, but they
here.
can't find housing.
They can't find housing,
Yeah.
so like it's money coming from. I mean, they're moving somewhere because this is national data. That the people with the assets, the money that benefited the most from this whole crisis is this last year are the ones that are now spending the money and driving prices drastically higher.
And this is why when, our issue every time we hear you tax the rich, like this is how much the rich move the economy. You know what I mean? That's like if you start causing or disincentivizing, I got to work on that word. Rich people from like spending, from doing all that, you're going to hurt a lot of the economy. You're going to hurt a lot of the market, because the lower income, lower class people are not spending at those levels. They can't. I mean, we've always read it before all this, like they always lived paycheck to paycheck, which was the reason for all the stimulus, for everything, because like people cannot afford to they don't even have a month worth of bills covered in their savings. So it makes it so difficult for them to contribute at the level that the upper middle class can contribute and the wealthy. So it makes it very difficult. I'm not saying love the rich or hate them. It's just the economy,
Another article that I had on that I found interesting was by a local university here, the University of Texas, San Antonio. Experts warn against simple fixes for post-pandemic labor shortage. So months after a variety of San Antonio industry leaders began raising concerns about a lack of available labor, that workforce shortages remain a very real threat locally and nationally. Employers may be in for a long wait and some new realities, and those who are counting on a discontinuation of COVID benefits to rectify the situation could be in for disappointment. There are multiple factors. It's not just one thing, said Thomas Tunsil, Senior Research Director at the UTSA for Economic Development. The COVID relief package was sort of a natural experiment. There are a lot of reasons why people aren't able to get back to work. Last month, Governor Abbott here in Texas informed the Department of Labor that Texas was opting out of the further federal unemployment compensation related to the pandemic effective June 26th. So as of tomorrow, no more $300 stimulus packages that are boosted unemployment benefits here in the state of Texas.
And what about the extended unemployment? Because a lot of people were also, you had that pretty much that, what was it called? There was like some crisis unemployment where it's like you have your jobs unemployment, but then they also extend your unemployment because of the crisis, where usually from your job, you'll get like a certain amount of money or time.
No, the crisis was it wasn't additional money. It was allowing more people into the program that were previously ineligible. Like if you were a gig worker.
I thought it was
you were
additional
1099.
money too, where you have a certain amount that you can pull from But as soon as that runs out, it's like you need to get a job.
Well, yeah, when they
they kept extending that.
The original COVID package, CARES Act, extended it from like 26 weeks to 39 weeks that you were allowed to get unemployment benefits. So I don't know if that's still in effect, where it's probably what you're referring to.
Yeah,
is like if somebody can,
too.
if you apply for benefits, you can get above 26 to 39 weeks of unemployment.
Right. That's what so I think that's one of the things that was also ending. So for people that have been on unemployment pretty much since this pandemic started, you're pretty much out of everything at this point, and you need to job, because I don't know, or food stamps or something. It's going to be tough.
A lot out there. So, according to the Texas Workforce Commission, the number of job openings in Texas is almost identical to the number of Texans who are receiving unemployment benefits, Abbott said. Tunsil said that additional benefits have helped people find work, providing access to transportation, clothing, and other basic needs some might take for granted. Meanwhile, the pandemic has caused some in the workforce to consider less risky employment. For others, it has shined a brighter light on wage inequities. And this is part of the article that I found very interesting that I think we could have a discussion about, is that they talk a lot about labor. Looming underneath it all, the social compact between labor and capital is being revised by the public at large. Tunsil said, noting that if the minimum wage had kept pace with the income gains at the executive level, it would be north of $30 an hour by now. So meaning that if minimum wage kept pace with the level of executive pay, minimum wage wouldn't be $7 an hour, it'd be over $30 an hour. So it's showing where they talk about the inequalities of, and what you're seeing in the labor markets, where people don't want to go back to work, where people see like, we want $15 an hour. We want all these things. We want higher wages. Now with this whole crisis, it's kind of shed light on that. It's like, when we pumped money into the market trying to help the market, the rich just got richer, significantly richer compared to the lower tier. Your executive got big bonuses. They got bailed out, and they're getting big pay raises, when it's like your labor force is being left behind, where people are starting to rise up and say, you know what? We're tired of this. We want better wages. We want more of this, like, and it's part of the capitalistic society of like the way our economy works, because like executive bonuses and pay is structured on increasing share price to shareholders and investors. Mm-hmm. Which, how do you do that? You increase productivity, or you increase your market share, and you keep your costs down. Well, the biggest part of your costs is your labor. So over the last several generations, people talked about like wages have pretty much stagnated. So it shows like corporate America has been able to increase executive bonuses because they've been able to keep their costs down and expand market share. But now with this new pandemic and these new situations, shed a lot of light of just saying like, well, this sucks. And now I think a lot of people are starting to realize that it's like, okay, now we want more representation. We want better pay. Like, I'm not going to come work for you. It's like, I will take economic pain, stand up and say, I'm not going to do it until you raise wages. Yeah. And now you see that across the board, where you have truck drivers that are making $150,000 a year because of shortages. You have people that are like, I just need people to come back to work. You want more money? Here, I'll give you more money because I need to increase my pay. And I think that's one of the things that's going to come out of this, why I'm kind of bullish on the economy, is there's been so much liquidity pumped in the market that they can now sell shares of their stock to reinvest to get people back to work, because now it is affecting their share price. It is going to start showing up when people don't want to work. You're going to start losing quality control. You're going to start losing market share to other people that are doing that. It's like, you know what? I'm going to increase my pay to my entry-level workers because now I see my competitor is faltering on their product, and I can increase my wages to $2-3 more an hour, and I can now take market share from them. So I think that is one of the things that's kind of happening right now. And I just found it very interesting how they said, like, and I didn't realize, I figured as much, it didn't surprise me that executive pay has grown faster than minimum wage in entry-level positions, but I didn't think it was to that effect. It would be north of $30 an hour compared to what it is now.
I don't think that's I don't think that's something that it's, I guess, fair to compare, because executive pay doesn't necessarily reflect on the price of the services and the goods being offered by that business, right? So you can pay more to your exec team because it's a smaller team, versus increasing your labor force, which is probably much larger, to $30 an hour. Now, everything that we talked about before, to increase that level makes the services, the goods, everything increase as well. Because now, I mean, we look at it in our own books. our biggest expense is our salaries. You know what I mean? By far is salaries. And it's just one of those things that's like, those salaries need to also produce the revenue to sustain the salary and the growth of the business. And it's much easier to increase your executive pay than it is to increase your workforce pay, because now it's like, your workforce much bigger. You increase their pay. That's a lot more money than just paying your execs.
Well, and that's what I said. I don't think it's an at fault. I think it's just shedding light on those issues, because it is. You're right. It's like, by increasing 50 cents or 10%, so you get a 10% boost on your executive, he goes from $1 million a year to 1.1 million a year. So now your net effect of $100,000. But if you employ a labor force of how many thousands of people and you give a 10% pay raise to everybody, it's like that $100,000 didn't go very far. So it's $100,000 at the top. The person that's running the organization that is driving that share price and everything like that. That is the way our system works. Yeah. That is how capitalism works. So there's nothing wrong with that, but it does show. It's interesting to look at. Like, maybe we should readjust how those things. Because it was also one of the things I find. I can't remember which act did it, where you had to make executive pay public, and they thought that was going to make people accountable. They're like, oh well, Coke's paying this guy this much, Apple's paying him this much, and they thought, like, okay, we're not going to raise prices anymore. But it actually had the complete opposite effect, that executive pay skyrocketed after they forced them to make it public, not bring it down.
Why?
Because now they were competing. They're saying, hey, Apple's making, Tim Cook's getting paid this much, and I outperformed his share price last year. Why aren't I wanting that pay? Yeah. So now they can compare. They have just like housing. My neighbor sold my house for this much, so I want that much. So you can't. It's not an internal thing based on just your negotiations with a team. Now you have outside data from other companies to compare it to.
This is also the issue with the more of the workforce area, is that your exec team, they have a unique set of skills.
It's harder to find.
Exactly. I know this is gonna piss people off. I don't mean in a mean way or anything, but they are worth more, because those skills come with, let's say, years of a degree, of studies, of experience, of executing correctly, of working for major companies. It comes with an array of that justifies the pay, right?
Yeah.
Where now the lower you go, the less skill those people have, which is why most of those people are not execs, right? And then you get to the major workforce, and it gets to a point where the company says, if we need to increase that much, we either need to cut our workforce, down and automate, or we need to raise our prices. So, and we're seeing a combination of the two, where it's like, yeah, we'll pay you more. It's just that now we're going to take on a different type of employee that can perhaps do the job of 2 or 3 employees plus some automation. Now we can afford to pay that employee an extra $5 an hour or something like that, where it makes more sense. Yeah. But they can't just keep the workforce doing the job. I mean, that's one thing that we've realized in our own business, how much we can automate and how much we can outsource to abroad, to offshores, for $4 or $5 an hour of things that's like, we don't need to bring on somebody and chew up so much of our salaries, of our income to grow the company on somebody that's like, that's a job that we can outsource at this point. And it sucks for a lot of people, and I get it, but at the same time, it's like, that is the world that we're in, and if we don't compete, if we don't stay profitable, we get put out of business.
So, one thing that kind of finishes the article out is like the pandemic has caused more individuals to question the way productivity gains have been shared between workers and investors. Where it's like, you think of the CEOs, executives, boards, who do they work for? They work for the investors. They work for the shareholders that own the company. So they're the ones that it's like, they're taking the risk, they're putting up the gains, and it's kind of taking a light that people don't cherish their time as much and aren't negotiating and wanting a higher wage based on their investment into the company. So investors have been doing it via their dollars, workers do it via their time. In the last, I don't know how many decades, it has been the dollars that have outweighed the time. But now with this pandemic and everything going on, it's really moving towards that. It's the workers and the time are now being like, hey, I want a little more for this if I'm having to do this stuff.
Well, they had another article that talked about the exodus of executives from Fannie Mae, and they're showing that like some of their executives, like this one lady, Celeste Brown, she is getting paid around like $2.3 million working for the Federal Housing Finance Agency. And there's a salary cap. There's a strict salary cap that won't allow it to go higher. So she's leaving.
There's a cap at at 2.3 million.
Yeah. But so she's an executive, has a higher level of learning, experience, everything. So she's leaving, going to another company that's offering her a $500,000 base salary and $3.75 million annual incentive bonuses. So now you're having execs leaving these government entities that we need people with higher skills and degrees and understanding to help carry what controls a lot of the housing market, a lot of our regulations. They're leaving because there are other firms that are paying them a butt-ton load more than what they're getting paid. That's there.
Crazy.
So
man.
It's like you look at those things and it's like, yeah, that the pay, this executive level, all that, huge competition.
Well, I mean, it is one of the things. It's like the private sector will do what the private sector wants to do because, I mean, that is what it does. To where, like, when you have the government agencies come in here, it's like, oh, we're going to limit this stuff. You can't do this. It's like, well, then fine, I'm leaving. Yeah. I'm not going to play this game with you. It's like, because there's people willing to pay for my set of skills because I can drive productivity. But when you limit, that's where, like, you and I talk about and agree on. It's like when you come in and try to stop productivity, been saying, oh, you can't pay this much or you can't do X, Y, Z. It's like there's going to be something that rattles out from that. And that is where if public policy, like some of these, the progressives that are coming, some of the things they want, well, you look at some of these countries like Venezuela, that it's like, we want more from the government. You're making all this money, and they squander things away, and you see what happens. And it's like, and it's just detrimental to an economy. It's detrimental to the entire people that said they wanted something better. It's because like you elected people into and that's why we have to be so careful of like, you can't leave generations behind. You can't leave sectors of the economy behind. Like you do have to have an inclusive economy because if one section gets too big, they can vote in people that rise up within their thought class and then they can come back and destroy everything for everybody.
Yeah.
So that is something that you do have to be careful of and you do have to be cognizant of. And I think that is why our system is so great here is because not one idea can rule, not one person can rule. Like if you want the government to do something, it's very hard to create social change, and one person can't do that. Yep. You have to have 500 some Senate or Congress people between Senate and House to get that done. So it's very hard for those things to change. Yep. So.
Well, moving on before we wrap up, I did want to touch on the cryptocurrency issue that we're seeing. I was reading an article with Michael Burry. If you don't know who he is, Google him. He's the guy from The Big Short, the movie. Everything made a butt ton of money during the last housing crash. He warns retail traders about the mother of all crashes. So he says all hype / speculation is drawing in retail before the mother of all crashes. He tweeted out, and then he said, when crypto falls from trillions or meme stocks fall from tens of billions, Main Street losses will approach the size of countries. History ain't changed. And he says, if I put GameStop on your radar and you did well, I'm genuinely happy for you. However, what is going on now, there should be legal and regulatory repercussions. This is unnatural, insane, and dangerous. So he has a habit of deleting his tweets soon after posting them. And early this year, the investor told his followers that some of his Twitter activity had triggered a visit by the SEC.
Oh no!
So,
and what Elon Musk can do whatever the hell he wants and not get slapped down, but this guy's like, ooh, okay.
Yeah. Well, because I guess this guy's more dangerous. And then Burry isn't alone. In his recent warnings about the cryptocurrency space, Mark Cuban, the billionaire owner of the Dallas Mavs and early crypto adopter, revealed that his Twitter followers that this week he had been hit by the drop from roughly $60 to zero of the DeFi Titanium token, part of a stablecoin project called Iron Finance. So they're all warning that pretty much the biggest issue that you're seeing in crypto at this moment is the retail market, as uneducated investors are coming into the crypto space. They're buying it up. They're pushing all these stocks to unprecedented numbers that it does not make sense. And they're like, you're forming a bubble that's beyond insane for a lot of retail traders. Because the savvy traders, like even on that plummet from 60 to 0, Mark didn't go to 0. He pulled out way before then. You know what I mean? Like savvy investors, they're not stupid. They know when to pull out. You understand? Where the retail investor, the ones that buy because it's going up and it's cool and I can talk about I own Dogecoin or whatever, like you are the one that's going to get hit the hardest by this kind of crash.
Well, I mean, it's the get rich quick. It's the amount of greed that is in the system revolving around those kind of things. It's
so. And then this other article I wanted to hit on is you have one of the biggest reasons that Bitcoin cryptos have taken a nice little dive and stayed low is China. So a value of major currencies, including Bitcoin, Ethereum, Cardano, and blah, 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 and Dogecoin, plummeted Monday after Beijing renewed efforts to rein...
Beijing.
What?
Is it Beijing? Did you say Beijing?
Oh. That's what you get caught on? Anyway, China...
I was like, what?
China renewed efforts to rein in the sector and severe power to Bitcoin mines in whatever province over the weekend, one of the country's largest producers of the digital currency. So China is the source of the majority of the world's cryptocurrency trade. A 2020 study found it to account for nearly 80% of global Bitcoin operations. Wow. 80%. It's insane. And Sichuan province is the second most intensive mining region. Local authorities claim that the latest crackdown has cut the country's Bitcoin production by more than 90%. The abundance of cheap electricity in China made it an ideal location to pursue energy-intensive Bitcoin mining, with a great deal of this energy coming from coal power station, an incredibly dirty source of energy. The industry is at odds with China's new climate goals. It is also a source of unseen in the crypto community.
Unease.
What?
It's a source of unease in the crypto community.
Either one. Yeah, a source of unease in the crypto community, most notably with Tesla billionaire Elon Musk, who brought about a market collapse when he announced that company would no longer use the asset until it cleaned up its footprint. Beyond the environmental impact driving the current crackdown, which has also seen mines closed in Inner Mongolia. I was like, Magnolia? Inner Mongolia.
Beijing.
And whatever, China is also keen to prevent cryptocurrencies from infringing upon financial order, prompting a ban on financial services facilitating crypto trade.
Well, I saw an article that Texas is actually trying to coax people from China, saying, hey, we got cheap energy. We got clean energy.
Oh, yeah, we do. They've been freaking shutting down power because it's too hot and they can't. People, can you please turn down your AC when it's 100 outside? Yeah, sure, bud. Good luck. Yeah, let's get more miners in here and use up the whatever screwed up energy sector that we have here.
But we just put out more windmills and more solar panels out
those
in West
things
Texas,
are working groovy.
And we can just, we're good to go.
So back at it, cryptocurrency has taken a nice little dive. From its high in the upper 60s, it's down. Yesterday it was below 30. Now it's like 33.
Yeah.
So, and it's just been hovering in that little range. Does this mean that crypto is a bad investment? It just means that you need to be educated as to why you're investing in anything, whether it's crypto, real estate, whatever it is. You need to understand the investment. If you're buying it because of the hype, you're going to be the last one to know when it's too late to pull out.
Yep.
And then you're going to just lose everything and then some. So I hope this helps, and it's something that you guys think about and keep in mind as you move forward with your investing. And that's it for us. I mean, that's it for this week. And next week, right before 4th of July weekend, we'll see if we have some cool outfits to represent.
I will.
America.
I just want you to like get a bald eagle tattoo and just put it right on the side of your head.
Have an eagle like
just
with the wings
eagle, just like its
down.
claws and talons coming out. Like, oh,
be insane. All right. Thank you. Thank you all for watching, joining us. Leave your comments below. Anything you want. Join our text communities, 210-794-9898. And you can ask us questions there. We're always communicating with our community, sharing information, everything like that. So make sure you join us. And with that being said, give us a thumbs up. That helps a lot. And if you haven't already, subscribe. What are you waiting for? Thank you all for watching, and we'll see you all next week.
Bye-bye.